Okay, well, with a couple of weeks to go in the year, the TSX has been enjoying some fresh momentum. We're a little weaker today, but coming into this session, the benchmark was up more than 2.5% in December after posting its best monthly gain of the year in November. It would seem some wild cards for performance could include oil, which, as we mentioned, bounced this week as the Fed news weakened the U.S. dollar. Another question is whether rate-sensitive sectors like utilities can find some momentum in 2024. Our next guest is a fan of some top names in utilities and the pipelines sector. Ryan Bushell is president of Newhaven Asset Management, where he also serves as a portfolio manager. Ryan, good to see you.
Thanks for having me.
Okay, how would you generally describe what's happening in the markets as we round up 2023?
Well, it's everything's good, right? We got our Fed pivot that everyone was looking for. 6 rate cuts now priced in for 2024, which is quite a bit. The thing that kind of flew under the radar was the 2 good Treasury bond auctions on Monday and Tuesday, and both the 10-year and the 30-year vintage. Now, those were pretty carefully orchestrated as they were additions to other on-the-run issues, and it seemed like they had because the last ones went so poorly in November.
Yeah.
But all of that helped to solidify the rate market, both at the short end and the long end. So now we're back to a big inversion. Again, that historically has not been a good signal, but for now, everybody's happy at least till the end of December.
We've got the Bank of Canada governor giving his year-end speech later today, but what's been happening in the bond market maybe also helps out Canada, before we even start seeing the possibility of rate cuts, just in terms of things like the mortgage market, that kind of stuff.
Yeah, definitely. I mean, the sentiment of a 5% 10-year bond rate or somewhere close to that, and mortgage rates in the 6+% range is a scary thought for a lot of Canadians, including myself. And so I'm not convinced we're done with that, frankly. I think the next move in rates next year very well could be higher, long-term rates, not short-term rates necessarily, but long-term rates. And we'll see. I mean, again, I said this at the beginning of this year, that we might get a strong economy, we might get rate cuts, but we won't get both. I think the same thing is true for next year. We're only getting rate cuts if the economy weakens significantly from here, or at least to the extent that the market's pricing them in. And therefore, I think it's a murkier picture for markets.
So if you're invested in interest rate sensitive stocks, like I mentioned, for example, utilities, which have lagged this year, you're somebody who's constantly looking for yield. How do you feel about how they could fare next year? What's your outlook?
Yeah, so the similar to what people have been doing with technology, it's been buy on dips. So every time rates rise, we've been adding. So we added some kind of early to mid-November. On a long-term basis, the structural thing we like about utilities is just the increase in power demand in North America. That is coming, that is happening. That to me is one of the surest things in the future for the economy in North America and the world, frankly, but North America specifically is where we operate. So we like that theme. We think that growth in utility CapEx is set to inflect higher on a multi-decade basis, and that should drive valuations forward. It's not so much just rates, but rates, when they go up, when we had that rise in rates recently, we'd like to add on those types of dips.
Well, anybody who's just curious about the electricity story going forward, listen to what Elon Musk is predicting on that front. It's pretty powerful, and obviously, if we're talking about EVs and all that kind of stuff, that's a consideration. Emera is a name that you like, and then broadening things out just to pipelines, because you often talk about pipeline names with us as well. Actually, Enbridge and Pembina did a deal, I believe, this week. So they're both in the news, but you like both of them. I mean, what is, you got Brookfield Infrastructure here on the list as well. What's the common thread? Different businesses, but the common thread.
Common thread is just energy needs in North America and the world, and exporting to the world. And so, we have a surplus of energy in North America. The world is consuming energy. I actually read a really interesting research paper yesterday on, as energy gets cheaper, sometimes people think that it means that it's the end of the use of energy, but it actually usage can inflect higher. So as steam engines got more efficient in the UK in the previous decade, people thought, oh, well, that'll be the end of coal usage. Well, it just meant that there was more adaptations and more usage for that. And that you see in, Elon Musk, referencing him, yes, electric vehicles, but cloud computing is a big thing here, quantum computing, the data center demand. So again, we just like energy, owning the energy basis of North America. So that's the infrastructure that is collecting a fee on the passage of energy, not necessarily production of it, but the passage of energy. So that's pipelines, that's utilities, and a company like Brookfield Infrastructure that has multiple different facets of their business that touch that space.
Okay, so generally you would say you're constructive on the Canadian stock market for 2024?
Yeah, that's a great question.
It's a big head nod there.
It'll depend on policy.
Yeah.
We're in a policy-driven market. So if we do get the rate cuts and the economy fares okay, you're going to see the market go higher. I'm a little more reticent. I think caution is warranted. So we're sticking to those needs sectors, not want sectors, and prepared for both cases.
Well, and thanks for sharing.